All right, we're gonna have to redo that. First day. We'll have this nailed down by tomorrow. Do 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 do. All right. Yeah. So to start, for those that are on the YouTube stream or just getting started, we will start with expectations. So we're very happy to have you guys all. We plan on this taking about 2 weeks. It could go a little over, might go a little under because we have not done this before. You're our first group. So just want to set that expectation right away. We're still trying to nail everything down and get it all streamlined for you guys. And that's why we had the discount, because we felt that we should give you guys a nice price for being our first group. So I just want to say welcome. And before we get started, we want to set some expectations of the course and trading in general. So first, trading is difficult, especially for those who have trouble aligning their actions with their beliefs, either in trading or in real life. Both are very difficult. So in light of this fact, we're not going to let you get killed and grind your account down to zero. And we do not expect anyone to be making any trades until we've gotten to the stop section of the course. And most of your work, probably in this first week, will be hindsight, because if you can learn to see it after it has occurred and look for the things that we expect for price action to work correctly as far as our entries are concerned, and you can see them afterwards, you'll be able to see them before they occur. So for those who want to succeed, we expect you to participate, and we expect you to humbly ask questions when you are unsure. And this is where we see who's new to trading and who has traded before. So if you're new to trading, that background music, I'm not sure about any background music. I don't believe there is any. Yeah. But if you are new to trading, put a 1 in the bootcamp chat. I want to see how many people we got that are completely brand new, have not traded before. And if you're not new, put a 2 or an emoji or whatever you'd like. And while you guys do that, we'll get the rest of the course up and going. Yeah, that was my next question. I want to know where they're all coming from. All right, so it looks like, oh, gonna have to meet you. Sorry, bud. But it looks like most of you guys have traded before. So if you've traded the Strat before, I'd like to see a 1. If you're trading technical analysis or any of that other stuff, I'd like to see a 2. Yeah, so the way that this is going to work every day is we're going to go through the PDFs and what we have created as far as the strat is concerned. We're going to get through all the content. And given that this is the first run through, we know there's going to be questions. So if you have questions, hold those to the end. We're going to have those answered. And then we're also going to update the slides to incorporate those answers. So even those who are not able to make it to the nightly streams will be able to see the answers to those questions, or at least have the answers to those questions in the slideshow or the PDFs, whatever you'd like to call it. Yep, everyone's new, and it's going to be a little clunky to start. All right, so 1. All right, so we got good chunk of stratters and also a good chunk of people coming from non-strat, so that's good. So if you haven't traded the strat before, just remember you're going to want to forget most of the things you've learned, because what we do is either opposite to that or just contrary to what you were taught previously. That being said, though, let's pull up the next set. Yes. Fair enough. So in Discord, if you're on a computer or on the desktop, you should be able to go to this little gear icon in the bottom left. That should be your user settings. If you click onto that and then go down to notifications, you can enable desktop notifications, so it'll pop up at the bottom corner of your screen. And you can also enable sounds and all this other stuff in here. What we want to make sure is that you have notifications enabled. If they're turned off, you're not going to get the tags. And you can see like you can disable all notifications, make sure that's turned on so you guys get the tags from us. And that looks to be about it. So just that notification setting, make sure you turn on those desktop notifications. All right. So as far as how the market works, there's a little mess up in that W. We're going to have the introduction. So another simple introduction to the strat. And then we're going to talk about the bid ask, how that works. It's very simple. Then we're going to talk about an aggregate and an aggregation period, because they're extremely important. And then we're going to have a little brief introduction to the candlestick and then what we can know so far about the market given what we talk about here. So the first part is we have to approach the market like a data scientist. And a data scientist is only going to come to conclusions that are backed by evidence known to be true. So in this same manner, we're going to want to use the Strat's 3 universal truths as our tools to gather evidence about what we know to be true about current price action. And before we can look at the tools, we must learn what the data is that we are working with. And welcome to the Strat. The YouTube link, yes, I can redrop that here. In the future, you can check, I'm going to actually pin it. So if you check pin messages, we will have it pinned every single night. So first, the bid ask. For every transaction in the market, you're going to have a buyer, which is the bid, and a seller, which is an ask. We'll also refer to the seller as an offer. So the bid is going to be what the buyer is willing to pay. So if a stock's trading at $100 and the bid's at 100, they're willing to pay 100 for that stock. The ask is going to be the price at which a seller is willing to sell. So if it's trading at 100 and the ask is 101, that's what price the sellers are willing to sell at. They want to sell at 101. And then you have a spread. The spread's going to be the difference between those prices. So if the bid's 100, the ask is 101, the spread would be $1. And these transactions between the bid and the ask are going to be the smallest building block of our data. So you also need to understand what an aggregate is. And an aggregate, in simple terms, is just multiple pieces of data put together. So when you open a stock chart, you're looking at aggregate data, which is the sum of many of those transactions occurring at the bid and the offer. So you can see multiple pieces of data creates one part of data or one piece, and that's called aggregate data. Multiple pieces create one. Then you have the aggregation period, and this is a measure of time. So every aggregation, when we're talking about charts, is going to have a period, which means a beginning and an end. So in this example, you can see we have data here, then we have a 15-minute aggregate. These 3 pieces of data were gathered between 8:30 and 8:45. So when all this data comes together, and it's about $1,100 or $11,500 or shares or whatever you'd like to call it worth of buying going on, that creates a 15-minute aggregate. And we could say they bought here 1,000, they bought here 10,000, bought here 500. So total, they bought 11,500, and they did that in 15 minutes. It's an example of aggregate data. So when we look at a candlestick chart, we're going to aggregate this market data into a candlestick. So each candlestick's the sum of all of the transactions that occurred within that aggregation period. So if this candlestick opens at 8:30 or 9:30 in the morning and closes at 3 or 4 in the afternoon, all of the data and all the trades that occurred within this day worth of price action is summed up in just this candlestick, because it opens here and it closes up here. And that's all the data for the whole day. So as far as what we can know about the data so far, for each transaction, there has to be a buyer and there has to be a seller, the bid and the offer. And therefore, there's never going to be more buyers than sellers or more sellers than buyers. And what I mean when I say that is, if you have someone that's willing to step up and say the ask is at $101, and the buyer's sitting down here at 100, and then they change their mind. They're like, I'll pay 101. There's one buyer and one seller in that transaction. There's someone who sold it at 101. There's someone who bought it at 101. So whenever a transaction occurs, there's never more buyers than sellers or more sellers than buyers. There's always going to be the same amount of either. So if you've ever heard of supply and demand, where people are saying that there's more buyers than sellers at this level or at this order block or whatever it may be, that's just, it can't be true. There can be more aggressive buyers where they're willing to pay up even more, but there can't be more buyers than sellers. There has to be the same number. And let me make sure we get back down in here. The other thing is that price does not move or bounce. It's going to aggregate, because whenever we look at a chart, we're looking at an aggregate, and that means price aggregates. It does not move. It does not bounce. It has nothing to do with moving and bouncing, because price does not have mass. Therefore, anything that tries to calculate it as like momentum or anything like that does not apply to price, because price has no mass. You cannot calculate momentum on something that has no mass. The next part is algorithms. So when we're talking about the stock market, we want to understand what we're trading against. So when we're trading in the market, we want to know what percent of the market is traded by these algorithms. What is an algorithm? And then how does the strat use this? Because it's extremely important to understanding what we know. So when it comes to algo trading, over 70% of trading on exchanges is done algorithmically. And what this means is that institutions use algorithms to enter and exit their trades. And most traders were taught to believe that algorithms take their money. As straters, we know how to ride the waves created by those algorithms. And you can see, if you just quickly Google it, about 60 to 75%. So what is an algorithm? Well, these algorithms are really simple. They're super dumb because people have to tell them what to do. And if it's an algorithm trading stocks or whatever it's trading, any asset, it has to be told 4 things. First, you have to know what asset class you're going to trade with your algorithm. Is it going to be a SPY? Is it going to be Apple, Starbucks? Is it going to be the futures? What's it going to be? And then, is it going to buy or sell? So is your algorithm buying Apple or SPY, or is it selling Starbucks or Apple, whatever it is? And then 3, how is it going to buy or sell? Are you going to be hitting the bid, which is an aggressive way to sell because you're crossing the spread? Is it going to be taking the offer, which is an aggressive way to buy because you're crossing the spread and taking the offer? Or is it going to sit on the bid, which is not a very aggressive way to buy? Or is it going to sit on the offer, which is not a very aggressive way to sell? So what is it trading, buy or sell, and then how is it going to do that? And then the 4th thing, the most important, is the time aspect. When is it going to execute that trade? And these are the 4 things that algorithms have to be told. So when it comes to the institutions and the people that we're trading against, in air quotes, we're not really trading against them. What we want to do is look at the chart and try and identify where are they actually buying. Because if you're some trader at Goldman Sachs or some other big institution, then you get this trade to your desk and they're like, hey, we need you to buy 100 million shares of Lockheed Martin. Well, what is that going to look like on a chart? It's like, well, they're going to go in there, they're going to put the algorithms on, they're going to say, well, we need Lockheed Martin, need 100 million shares, we need it by this date, and we're going to start buying it at this time, and we need it right now, so we're going to take the bid. So what would that chart look like? Well, it would just go straight up, because 100 million shares hitting the offer, taking the offer, that's huge. It'd be a giant move. So that's what we're looking for. And that's how it works, because if you're some trader at a trade desk, they're just telling you what they need filled, and you have to go into the market and put those trades in and fill them. So that's what we're trying to pick up on. And the other thing I'd like to add is when it comes to these algorithms, you're going to see, I don't know if it says it specifically here, but when you look at these algorithms are heavily biased by the people who tell them to do the things. So it's not like the algorithms are just turned on and left. More often than not, it's a person going and telling these guys like, okay, this is what I need to do, and I need it by this time, and we're going to start doing it now, and blah, 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 blah. So it's people controlling these algorithms that are very simple. So since we know how these work, we want to use that knowledge to pick up on their activity. And this is done using multiple time frame analysis and simultaneous breaks, which we'll get into in later parts of this course. The important part now is just understanding it's algorithms you're trading against. The next section is charting. And we're just going to talk about charting platform, how the platform can trick you when you're looking at charts, and a simple way to fix it. And this is something you'll have to do. Hopefully you guys do have charting software that you've got. If you don't, that is some questions we can get to towards the end as far as which platforms and all of that stuff. But charting. There are many different charting platforms, and these platforms give you access to market data. It's going to aggregate the data for you. And depending on the platform, the periods may start at slightly different times. So the data displayed to you on a 60-minute may look completely different depending on the platform you're trading on. So you can see, for example, these are both 60-minute candlestick charts of the same stock on the same exact day. And they look completely different because one starts at 9:30 and the other starts at 10. And both of these are accurate 60-minute aggregations. So you'll see SPY down here, this is a 60-minute chart. Each of these is 60 minutes. This down here, also a 60 chart. And you'll see how they look completely different, where when this candle was red, this candle was still green. And this is a really important concept because the chart's only going to show you what it wants to show you. And as you can see, it's only going to show you what it wants to. So whenever we're looking at a market, we're using more than one time frame. We want to ideally use at least 4 because this will remove the bias that any one time frame provides by allowing you to confirm it across different aggregations. So this is something we'll get more in depth into later in this course, but it's just important to understand. We use multiple time frames because if we're looking at this 60 and it's red and we want to be playing short because it's red, on a completely different, similar 60 chart, they're both the 1 hour, this can still be green. So you can have that conflicting basis just depending on your charting platform. So it's incredibly important to use multiple time frames. Now, very simple trading. And we're just going to talk about what is a trade, the simple aspects of it. So a trade's going to have 4 major parts. An asset class you are buying or selling. So similar to the algorithms, you have to know what you're trading. You're going to have an entry price where you're going to enter the trade. And you're going to have a magnitude or a target that you're aiming for. And then the most important part, you're going to have a stop loss that exits the position to reduce unneeded loss. So as long as you know this, and when you're playing the strats, as we get further into this course, you just need to be very aware. You have to have an entry, you have to have a target, you have to have a stop, and you have to know what you're trading. If you don't have these 3 parts down in here, you do not have a trade. And that completes the little introduction to the course. I realize we did go through that a little quick, so before we get into anything else, I'm fine with taking any questions that you guys may or may not have. So just let me know in the chat if you have any questions. And it's an introduction, so that's the short part. We will be able to get into a little bit further parts of the course than I was expecting today, so that's a good thing. And if you're going to be asking questions, please ask them in the BootCamp area of the Discord. #BootCamp. I'll give you guys a few minutes to do that, and then we will get started on the next part. And if Sarah would like to take the reins, she can totally do that. Yes, you will get all the slides. We're going to be sharing them afterwards, ideally very soon after we end this off here. But if we have any questions or things that people need clarified, I want to add them to the slides before we end up sharing those, just to make sure even those that are coming in late or that are unable to make the live recordings can get those answers. The overall scheduled plan, it is here. Just give me 1 sec. I'll pin that to the boot camp as well. That's a smart thing. Thank you.
We stick to Japanese candlesticks because we want to see what's happening and what's happening right now. We don't want like an average of what's happening, which is like your Heikin-ashi candles. And Japanese candlesticks have four components. They have an open, a high, a low, and a close. And we are going to cover green OHLC candles and red OHLC candles. And red is where most people tend to get confused, but we're going to cover it. So, all right, so you've got, I already covered this, Japanese open, high, low, close. So each candle, whatever time frame you're looking at, so if it's a, oh, I probably, yeah. So if you're looking at a 15-minute candle, it'll show you the price traded in that 15-minute period of time. So where it opened, because every 15 minutes we get a new candle, and every 15 minutes we get a new open. And so, for instance, a 15-minute candle is going to show you where we opened, where we closed, the high and the low that were traded within that 15-minute period of time. And same thing goes for whatever time frame you're on. So if you're looking at a daily candle, it's going to show you the price that was traded during that entire day of price action, where it opened in the morning at the opening bell, where it closed at the closing bell, and then the high and the low. And let me scroll down, kind of doing this simultaneously with Alex. So a green candle, and we have these labeled. So one is the open, because every new candle, the very first thing it prints is the opening print. And then it will have a low, so it will have traded down usually. Some candles don't have a low and they just go straight from the open, but typically most have a low. The close, so when the market closed, that was the closing price, and they will also have a high. So whatever time frame you're looking at, if it's the 15-minute, the 60, they're all going to have this. And just remember, green candles open lower and they close higher. Okay. People get so tripped up with red candles because they're the opposite, and most people tend to have a bullish bias, so they forget this. But a red candle, you'll see the number one. Oh, go down, Alex. Thanks. A red candle opens near the top.
Oh, 1 second, Sarah.
Oh,
They're saying that the volume on YouTube is low. 1 sec.
all right. For you or for me or for both?
Your volume on YouTube is low.
My volume. Okay, let me
Yeah,
turn my volume.
I've got you turned up on my end. For some reason, looks like my desktop is just keeping it really quiet.
I mean, I'm pretty cranked up over here.
Yeah, let me
I can bring my mic closer.
test. Can you test, Sarah?
Test, test, test. Is that better?
Nope.
Oh, somebody said sounds fine.
Both volumes fine on Discord. Yeah, that's the problem. And I figured we'd run into problems on the first day, so let's see.
Test, test, test. Ooh, so loud on my end.
One more time.
Test, test, test.
It's still pretty low. I'm very
Should I turn
unsure.
off my NVIDIA broadcast maybe?
No, 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 no.
Okay.
Let's see.
It's because he's streaming like my sound through his computer. So let's work on that.
It looks like we only got one option here. Either you can take over the YouTube stream, so at least have that volume fixed there, and I can keep my stream going on Discord, or not. It's up to you.
Um,
And I could share the PDF over.
hold on. What do you want me to do? YouTube, take over the YouTube stream?
Yep.
Don't know how to do that.
You just start streaming, and I'll end mine.
Just do I need to turn OBS on?
The same way you'd normally stream.
So yes.
Yep.
Second.
Yeah, we're only slightly bogged down. The good thing is, as far as the introduction stuff, it's pretty quick to get through. Once we get to more of the, I guess more of like the concepts part, that's when we're gonna probably need the whole hour and a half as far as getting through all of that stuff. So let me know if you're gonna click start streaming, and I'll end mine, and then you should be able to pick up from where you are.
Hold on 1 second. YouTube streaming. Strat BootCamp Day 1 intro. Okay. Just trying to get. I feel like my Figma doesn't look as good as yours. Hold on.
I shared the PDF in Top Flight.
Should I redo this whole section? Do you think then if it was too
Uh,
quiet?
yeah, that's fine.
Okay. Okay. All right. So you. All right. So I'm gonna hit start streaming, and then
Yep.
it will simultaneously start recording because that's what I usually
Uh,
do.
Uh, yeah, but that's doesn't matter. Yep, you got it. I put the PDF in top place, so you should open that.
Well, I'm loaded up right here, so I'm just gonna do that. Can you see the Figma screen? Okay. Okay, so we're gonna start this section over because my audio is bad. So in the Strat, we use Japanese candlesticks. There's many different types of candles and bars and lines that we can use, but when we're trading the Strat, we want to know what's happening right now. So we want to know immediately the open, high, low, close. So that's what Japanese candlesticks are usually referred to. They have an open, high, low, close, and those are different for green candlesticks and red candlesticks. So there is an open, high, low, close for every time frame candlestick that you're on. So if you're on a 15-minute candlestick, you're going to get the open, the close, the low, and the high of that 15-minute period of time. And same goes for the day. So if you're looking at a daily candlestick, you're going to get four really important pieces of information: the open, high, the low, and the close. Okay. Because every new candle that forms, we get all of those new things. So a green candlestick, the open is usually near the bottom because when a new candle starts, that's the open. That is the opening trading price. Usually trades down, makes a high sometime during whatever period time frame this is. So if this was a daily candlestick, this would be the high of the day that was traded. And then this would be when the market closed, the bell rings, everybody's done for the day. That would be the price that it closes. And so it's important to remember that green candles open lower and they close higher. And a red candle is opposite of that. Okay, so it opens higher. The open is at the top of the candle instead of the bottom, like a green candle. Trades up, pukes. We love to say pukes in the Strat. Um, Makes a low, whatever time frame this is again, and then it closes whenever this time frame closes. So it's important to remember green candles open lower, close higher. Red candles open higher, close lower. And aggressiveness. So based on the color of the candle being green or red, it tells us who is in control, if the buyers or sellers are more aggressive. So if the candle is green, green means they're buying. So the buyers are more aggressive. If the candle is red, it means the sellers are more aggressive. Let's see. So that was just a short little thing on Japanese candlesticks, and that's what we use. We don't want you guys using Heikin-Ashi candles, line candles, any of those things. Um, we want to know what's happening right now. Um, Hold on 1 second. PDF. Alex, do you have the PDF for the inside bar? Because I don't like how I'm seeing all these other things on the side.
Showed it with you.
But it's the whole thing.
Yep.
Second. Okay. I see what we got going on here. We're going to pull this over. Okay. I think that looks decent. Except all this stuff on the left. I don't know. I can get rid of that. Yes, exit. There we go. Okay, so the next thing that we want to cover is the Strat scenarios, which are the 1s, 2s, and 3s of the Strat. So price can only trade in 3 ways. You either can have an inside bar, a directional bar, or an outside bar. And we're going to kind of cover what those are if you aren't familiar with what they are. So an inside bar, this little red candle, is considered an inside bar because the high and the low, which we just learned about, is completely inside the previous candle's high and low. So this would be considered an inside bar. We have lower highs and lower lows to, lower highs and higher lows to the previous candle. Inside bars typically have a mother bar because they're completely inside the range of the previous bar. So we refer to the previous candle of the inside bar as the mother bar. So pretend this little inside bar is the baby bar, right? Mommy, baby, makes sense, right? Big, little. We also have compound inside bars to a mother bar. So this big mother bar, all of these bars are completely inside the mother bar's high and the mother bar's low. This is not what we want to be trading. This is where you're going to get chopped up. Still inside. So I guess I feel like I should have said that an inside bar, we can only call an inside bar once it's closed, because a 1 can become a 2 can become a 3. So when a candle is still live, we identify it as presently inside or still inside, because just because it opened up inside the previous candle, if it's still open, it can become a 2, which we haven't discussed yet, but it can take out one side of the previous candle if it's still open. Inside bars are also referred to as an equilibrium. An equilibrium tells us that both buyers and sellers agree on prices, and we are by definition in a period of consolidation, which again, we don't want to be trading that. We want to we got to wait. After this candle closes, the inside bar closes, we can identify our known pivots, and known pivots are where traders place their stop losses and their buy orders. So these levels become important to us once the candle closes, which we'll get into that later. Okay, so that was a 1. 1, inside bar. 2 is a trending bar. And then these are the contents we're going to talk about, but I'm not going to read them. We're just going to go through them. So a scenario, so there's two different scenarios. That sounded not good. There's 2 different kinds of 2s in the strat. We have 2 ups and 2 downs. And a trending 2 is a directional 2. So this candle took out the high of the previous candle. So this candle is considered to be a 2 up. Price is by definition trending up. We have higher highs and we have higher lows. Okay, so a 2 up, that's all it means. It broke the upside of the previous candle. Okay, so a 2 down is just the opposite of what we just covered. This candle breaks the downside of the previous candle. So by definition, price is trending down, okay? And it's important to note that twos are classified by their direction that they break the previous candle and not the color. So this is a red candle, yes, but it broke the upside of the previous candle. So this is still called a 2-up. And we added here, the most common mistake we see is people thinking that this red candle is a 2-down simply because it's red, but that's wrong. It's still a 2-up because it still broke the upside of the previous candle. This is what we call a conflicted 2-up, because when you think about the direction up, you should think green, but it's not green, it's red. So that's where the conflict comes in. We also call them failed twos because it's unable to maintain its original direction and the other side took over. So even though it broke to the upside, the buyers weren't there, the sellers stepped in. So we either call them a failed 2-up or a conflicted 2-up. But they still have the same characteristics: higher high, higher low. So this is going to be important to note when we get into the later sections about actionable signals. And same thing with a failed 2-down or a conflicted 2-down. This green bar is a 2-down. But again, when you think down, you think red, but this is green. So the sellers are not there and the buyers have taken over control. I said that. Conflicted twos or failed twos. And I already covered this. When you think of up, you think green. When you think of down, you think red. When they aren't, this is what makes them conflicted. And then we often see reversals occur in the other direction on the next candle, which again, we will get into that when we get into actionable signals and reversals. And then the third strat scenario is an outside bar. So we're just going to get into it. So a scenario 3, being this big green candle, takes out both sides of the previous candle. And this is really important, but we took out the lows, we started coming back through, we took out the highs. So outside bars have a higher high. If you imagine a line here, a higher high and a lower low to the previous candle. And fun fact, an outside bar is a broadening formation on a lower time frame. Oh, there's the lines, which we're going to get into coming up real soon. So if we look at the above candle, this one, on a lower time frame, you will see the lower time frame broadening formations and 2-2 reversals, which again, we're going to learn in the actionable signal section, are compound outside threes. So if we broke this chart and we took these candles and broke them in half and made them 2 candles for this red one and 2 candles for this green one, these 2 green candles are an outside bar of these 2 red candles, which is how we gauge our magnitude and where we know where price is trying to go. And here you can see it just depicted with yellow boxes. These 2 candles are an outside bar, a 3 of these 2 candles. And this blending candles with your eyes is important, but you don't need to learn it right now, but this is what we're doing. So we're what did Rob always say? Analyzing data, because the charts can present themselves however they want. So it's important that we recognize what is really happening. And outside bars are a range expansion. So when we talked about inside bars, they were a tightening range, a consolidation, but outside bars is the price action expanding and getting bigger. So in this example, when this candle technically gap down, but when we fail to stay below previous lows and we start coming back through, we already know we're trying to take out the other side. What what makes trading hard is scenario twos can fail and become three. Learn to recognize this and you will always be on the winning side because we know where people place their stops. So anybody who was long during this candle and through this candle, they would have to get out when we came back below this candle. And anybody who is short this candle through the life of this candle would have to get out when we made a new high. So we know where people's stops are placed. They're placed at obvious pivots. I think we have a duplicate slide here.
That's not the end.
It's all right. I think that's the end of that one. So yeah, the ones, twos, and threes. One inside bar, two directional, three outside. Okay, I can't scroll anymore. That's all there is. Unless, nope.
So if you have any questions about the ones, twos, and threes, feel free to drop them in the bootcamp section, and we'll make sure to get those answered. And even if it sounds like a stupid question, all questions are welcome. More questions, the better.
Um, I don't see any questions. I hear people saying the YouTube stream ended.
It's before, don't worry about it.
Oh, well, I don't. As you mentioned before, a two or three is formed. A candle is usually a one. How do we enter setups? Since we don't know which side of the range a candle might take out, you could have a two up or two down scenario. So you usually set a stop.
You should read that a little bit clearer, please.
Oh, you know what? You handle it.
Yeah, well, obviously the question is 1 second, let me pull up a whiteboard. And Sarah, if you want to try and transfer the stream over, if the stream does end or it says it ended, it's a command.
Okay. Okay, I'm gonna stop it right.
And going forward, since we know there's a little bit of issues with doing that, we will switch it up and make sure that there is no cuts in the future. All right. So if the stream cuts out, here is another stream link for you guys to click. And in the future, that won't happen. We'll make sure to fix that. So the first question is, as you mentioned, before a 2 or 3 is formed, a candle is usually a 1. How do we enter setups then? Since we don't know which side of the range the candle might take out. You could have a 2 up or 2 down scenario. So do you usually set a buyer stop above or sell stop below to enter? So when it comes to entries, we're going to get to that. It's not very important to understand now, but when we enter, we try and enter on reversals, meaning we're going to be entering at the high or low of a candle, but we're going to do it as a reversal. So if prices were going down before, and then we get a 2 to the upside, we would be entering at the highs of the reversal of that. So we'll get to that in a later part of this course. We're not going to get to it tonight, but good thought there. Now, oh, that's fine. But the last slide is a little bit muddy for me. Can we explain that in steps of how the shorts get stopped out? So if you've ever traded before, everyone tells you to put your stops at the highs or lows or where you got in. So when we're talking about range or candlesticks with the strat, what we want to think is if there's a chart and let's say it's going up like this, where people are going to put their stops is at obvious pivots above highs or below lows. So when people are putting their stops here, since we know everyone is told to put their stop there, we know when we take out these previous lows, people are getting stops out. The other place people were told to put their stops is inside the previous range. So if price has just been kind of grinding up for a while, people are going to have their stops either where they got in or at these obvious pivots within this whole range. So when we come back through a range, we know we're stopping people out for sure, because that's what most traders were told. And we'll talk more about that as we get into the later parts of this course. But the important part is just to know if you have a previous high, people will have stops above that. And if you have a previous low, people will have stops below that. So whenever we're looking at a candlestick like a 2, if we have a 2 directional to the downside and we take out the previous high, anyone that got short within that 2, first of all, they're losing, because if we're trading now up here above it, these guys who got short before, they're underwater. And the second thing we know is their stop is either here or wherever they got in within that candle. And the next question is there times to ignore noise like pre-market? So as far as the strat's concerned, we only trade the, I guess, intraday session. We do not trade pre-market, although you can. There is people that do that. So when we're looking at charts, we actually do not include any pre-market data because we want to understand what they're doing intraday more so than pre-market. If you trade futures, so if you are a futures trader, you can use futures, the overnight session data if you'd like. That's perfectly fine. But what's more relevant to us, since most of our trades are taken during the trading day, is we're actually going to be using the SPY, the Qs, the IWM, and the Dow Jones to base our trades off of. Even if you're trading something like ES, for example, we're going to be looking at all 4 indexes, and the intraday signals are what's more relevant to us. But when you have like news events and stuff, pre-market or any big volatility that can be occurring, definitely can be trading that with the same concepts. You just have to be aware that you have that New York Open coming at 9:30 EST. Yeah, so the compound 3, it's super important because what we need to realize is when you have a 3, what it's telling you is, first of all, there's a previous range, and price attempted higher, failed, took out both sides. So since there's 3 scenarios, you can either have the 1 getting stuck inside, or you can have a 2 directional, up or down, or the 3. The 3 tells us what price actually does and how price action works, because if we know price will fail one side of the range and attempt to take the other side, we can gauge the magnitude of moves, because we know if price is just trading in a range and breaks out, most people are trading shorts on this breakout. We want to know when it comes back in, because then we can target the other side. And anyone that was previously short, putting their stops up into this stuff, we can take all those guys out. And you can see that's going to look like a 3 on a bigger time frame. So as far as the scenarios are concerned, once we get to reversals, what you'll notice is pretty much every reversal pattern is going to have a compound 3 in it, or every single one. Yeah, sorry. Did I forget to do that on that one? There's a he mentioned never realized all combos were a compound 3 or reversals were a compound 3. So we're gonna get more to that once we get to the reversal section. But thank you. So no, you actually can do this across any time frame because, and I don't want to get to the charts yet, but we can get into the charts and I can show you. When we open up any chart, we're going to use 4 time frames, but in this case, we're just going to go on 1. What we're doing, since we're analyzing data and looking for the scenario 3, you're going to do it across all time frames, because if we see, for example, you'll notice this. See how all of these bars are a scenario 3 to all of these bars to the left, like so. When we see that on a monthly basis, unlike traditional technical analysis where you have support and resistance on the daily and the weekly and the monthly time frames and you're kind of confused by it, when we drop down to a daily time frame on Apple, for example, that 3 is still apparent. So like all of these daily bars also made the 3. So one thing you'll see that's different with the strat compared to other strategies is what we know to be true on higher time frames also occurs on every other time frame. Unlike if someone's looking at like a head and shoulders pattern up in this stuff up in here, when we go to a monthly chart, there is no head and shoulders, right? So that pattern's irrelevant as far as we're concerned. And once we get to like the yearly or quarterly charts, you see there's no head and shoulders in here. It's just a scenario 1. So it's very, very important that you can do that and blend the candles with your eyes, which you'll get really good at once we get over to the reversal section of the course. So not only larger time frames, but every time frame. So like, for example, today, if we're just looking at the compound 3, you can see SPY today, what it did. And I posted this on Twitter. You'll see on the 60, all these 3 bars became a compound 3 to these 3. So if we had a 3-hour chart, this is a 3 to that. And that's how we can gauge the magnitude. Once it starts reversing off low a day, we're looking to go outside of this stuff, which we will get to. I don't want to throw you guys too much stuff on the first day. Now, as far as what we want you guys to do, because we don't want you guys to just listen to this stuff and then go and do nothing with it. We want you guys to get good at this. If you can, I want you to find me. You can just go through any chart, doesn't matter, asset class, time frame, whatever it is. I want you to identify the 1s, 2s, and 3s. And ideally, if you could, identify those without any of these indicators. So you can see the indicators will tell you the 2s and 1s, 2s, and 3s. But what we want you to do is get good at just opening a chart and knowing what you're looking at. Because once we get into the execution and the analysis part of this, we're going to have you looking at 4 time frames at the same time. And you should be able to look at 4 time frames at the same time and identify exactly what's happening on each time frame with the scenarios. So your homework tonight is pretty much to go into any chart, identify a scenario 1, identify a scenario 2, and identify a scenario 3. And if you could, post it into the bootcamp section, or Sarah, I don't know if we want to make use of the homework area of the Discord since we haven't used that recently. That could also be used. I think we should do the homework area. All right, that's fine. I can do that quickly. Yeah, and for those on the YouTube stream that can't hear Sarah right now, I made sure to turn it off since it was a mess before. Uh, Tonight in the homework section, we're going to tag all you guys so everyone has it, even if you're not here. But we want you to identify the scenario ones, twos, and threes, and we want you to identify, ideally, the one, two, and three. Identify a conflicted two, and identify that up and down. So a two down but green and a two up but red. And we want you guys to use the camera. If you have trading view, click that, copy the image, and then paste it in the Discord. We don't want pictures of computer screens and whatnot. But that's going to be most of what we're going through today. Really simple stuff. It obviously will get a little bit more difficult as we go forward, but it should be really simple. It's pretty intuitive if you can learn the concepts and identify the scenarios. The rest should start making sense very quickly. So that being said, we will have the boot camp homework section up in just a second here. I'm working on the permissions, and then we should be good to go. So first. All right. So we do have the homework assignment posted there, and we will go through and we'll answer your questions and check those as the night goes on, as well as tomorrow because everyone's got to sleep eventually. But that's going to cover most of what we wanted to get through today. The PDFs will be shared. There will be a PDF channel in the Discord, and the YouTube stream will be sent out as a private video to an email list that we have gathered from just the bootcamp subscriptions that you guys have created. So the boot camp, yeah, the PDFs, we'll get those out in just a second here. Yes, over voice instead of text. Yeah, we can get that over voice. We're just gonna have to mess around with my audio settings in the future just so we don't have any problems with recording that voice audio, but I will make sure to get that done. So this is going to be a last call for any and all questions, and that's going to end off pretty much what we wanted to get through tonight. We're done about 20 minutes early, so I have some time to go through homework for those that can get it done as soon as possible. Yeah, we can do that too. Yeah, we're going to move everything into a bootcamp section real quick. All right, so should be all in there for you guys. All right, so it looks like everyone's all clear and we got everything good. So we will see you guys. Yep, we'll see you guys tomorrow night. And in tomorrow night's session, what we're going to be talking about is the reversals and continuations. So it's going to be a little bit of a longer section, and it's going to be specifically what we are looking for when we're looking at a chart in order to take action. So it's going to be what reversals look like, what continuations look like, and the different types of setups such as the pivot machine gun and all of the other cool stuff with the Strat. And we'll also have tons of examples that we can go through so you guys can train your eyes to see it. But that will be about it. So I will see you guys tomorrow night with Sarah, and I hope you guys have a good rest of your night, and make sure to get your homework done. Remember, post conflicted scenario 2 up and down, a scenario 2 up and down that's not conflicted, a 3 and a 1, and that's going to be about it. So adios.